Hey guys, today we have on Rajiv from Framework Ventures, somebody who I talked to a good bit. I feel has very good pulse on the market, both like the public markets and also obviously a partner at a venture capital firm. So he should, I assume, have a good pulse on the private markets as well and what's going on there. And well, it seems like quite timely to have a discussion. So Rajiv, welcome. Introduce yourself, tell us what you do, and maybe a little bit of background as well if you want.
Sure. Before we get started, I'm going to give like a quick disclaimer for the sake of compliance, but nothing I say here should be taken as financial advice. You know, all views represented are my own, not the firm's. The firm may have positions and assets discussed here, you know, yada, yada, yada. But yeah, I'm Rajiv. I'm a partner at Framework. Framework is a crypto native investment firm. I've been here for a little over 3 years. Prior to Framework, I was a software engineer at Coinbase, mostly working on staking stuff. And before that was a software engineer at this company called 8 Sleep, doing non-crypto stuff. Great product if you guys don't already have one.
Yeah, well, they're like $10,000.
Yeah. So the way I tell people about this is like if you're going to spend the money on a bed anyway, and you want a good bed, that's pretty good. That's it's a good bed to get. If you're not going to spend the money and you don't care about your sleep that much, you probably shouldn't spend the extra amount. And then the other thing is if you travel a bunch, like it's kind of not a great bed to have because like you just get terrible sleep everywhere else. Like whenever I travel, it's awful, honestly. So yeah.
Okay, awesome. Well, give us a little update on the venture markets right now. I mean, what's coming across your desk? How do you feel about it? Just start riffing. Give me the
absolutely.
vibes. Give me the vibes, and then I'll probe.
The vibes like flip very fast in venture, like especially crypto venture. I think where public sentiment impacts private sentiment quite a bit. You'll see this where it's like, you know, the price of Bitcoin will go up. People will be like, okay, now I should start fundraising. People will then think, okay, what companies have not been funded that, you know, I should consider putting money into because I would like to work with. And kind of there's this like very compressed cycles where there's a lot of activity and then periods where it's a little bit quieter. I think we're like kind of in a steady state right now. I think I think there's definitely like the interesting part is that there's actually some like talent inflows. Like I thought previously, you know, maybe through most of 2024, there were not many talent inflows where there's like net new people coming into crypto. I think, you know, I think there was mostly outflows, potentially like, you know, people leaving for other fields or just choosing to kind of step back from the space generally. But I think there are talent inflows and there's like a lot of like super early stage stuff that's like getting started. I think like sort of like mid stage, like you see some products, protocols, et cetera, that are doing okay, that I think are sort of able to, you know, maybe raise some capital and move further. I think like the really late stage growth rounds though, like I think there haven't been a ton of those lately. I think like there was the Walrus one that Sander did, but outside of that, I think it's been a lot quieter. So I'd say it's like mostly early stage, and there's actually like some semblance of net new people coming into the space. And I would say in general, like the cohort is actually relatively talented. Like I guess, you know, part of this is also biased. Like I'm based in San Francisco. I talk to a lot of people in San Francisco who like previously have had, you know, careers in Silicon Valley for a long time. A lot of them are fairly competent, I think, especially relative to like the existing set of people in crypto. So I think like that's like reason to be excited. There's also a bunch of companies that got funded in 2021 that like struggled for a very long time that are now sort of starting to like find some level of product market fit. Still super early stage, like probably like, you know, in the seed extension Series A range sort of. But, you know, I think that's still encouraging because those people chose to work on it for a very long time. They're sort of starting to hit some stride with like their product and business. Most importantly, business is the key word, right? Like I think, you know, while there still will be a lot of investment into things that are speculative, you know, things that have historically had big outcomes, I think people are very focused on, you know, building real businesses because like it's just everybody sleeps better at night, I think.
Yeah. When you say new talent inflows, like what are these people coming in to do? Like what would you say is like the archetype? Like are they coming to bring fintech type products to crypto? Like what is the read you get generally? Like what people want to build when you say, you know, we had all these people leave. Right now, there's like this new cohort coming in. Like, what are they excited about? Because a lot of us in this space are kind of like,
I don't think the cohort is massive. Like, but I think it's like represents net inflows relative to the outlet flows that we've seen, which I think is positive. I think like there's two buckets mostly. The first bucket is like more fintech oriented. It's rarely protocols based. I think it's like often kind of like more like traditional financial services that monetize in some way. And it could involve crypto assets. It could be like an intermediary for crypto stuff. It can leverage like crypto assets in some new way, like potentially stuff like that. And then the second cohort is like, and this might be a tired subject, but like there are actually some decent AI people coming in to like do things that they think are legitimately interesting. And that might be able to leverage crypto networks. I think like, a lot of that is super early stage. So like we'll see, but there's good reason for certain parts of it to be like reasonably geographically decentralized, for very specific things, essentially.
Yeah. What interests you about I'm gonna like correct myself if I've been saying this, but like what interests you with like the intersection of AI and crypto? Like where are the like value propositions there, right? We've heard about this. Well, we've really heard about this for like 5 years, right? But like we've especially heard about this in the past year, obviously, with like the AI boom. Like where is the intersection?
I haven't spent a ton of time on this, candidly, so I probably am not the most informed here, but I hate the word deepen. I think it's like has a really bad connotation, mostly just as like a historical remnant of the projects that have been associated with the word in the past, right?
Yeah.
But I do think there's like something to like where, like if you benefit from having like building an on-chain marketplace is potentially useful if it's globally distributed, right? And I think there are interesting things to be done if you can incentivize the right people to actually participate in this marketplace. So I think there is stuff there, which is like super niche and specific, like, and I don't want to dox any of these companies, so I won't say much there. I think like some people are really interested in the decentralized training stuff or decentralized fine tuning stuff. I've seen more of like the fine tuning thing is kind of interesting, right? Because like fine tuning stuff is kind of hard, and like it's less of like this happening on chain. It's more like coordinating activity, I guess. I think like trust assumptions are super hard with a lot of these things. But I think the other reason people are excited about this, candidly, is like people are excited about AI stuff. And then I think the caliber of some of the people is like quite high, which, makes it easier to get excited about, especially if it's early stage. So like, you don't have to prove out traction quite yet. Like it's like, you're making a bet on the team and maybe a potential market. Also, like these AI companies all spend like infinite money, and like some of them are willing to potentially even use some of these things that are built sort of like maybe some of these deepen things, some of them are willing to use it, right? And they're like willing to pay real dollars for it. So I think that's like potentially exciting to some folks.
Yeah, that seems like at least mildly encouraging. What do you like as a partner at Framework? Like, what do you focus on? Is there anything specifically that like you're kind of the go-to person for? I know you guys have, like, I assume a few partners. Like, do you have any like vertical that you're kind of are the expert on, or you spend a lot of your time on?
We're all generalists at Framework. I think like it's important to know about everything, and like maybe you choose to spend time on areas that are a little bit more exciting to you. I historically have liked a lot of like DeFi stuff. I've liked some infrastructure stuff, like maybe specifically L1s. And then I would say outside of that, like I've spent a good bit of time over the last year sort of like on Bitcoin-based financial products, because I think Bitcoin is probably in a very large way here to stay and going to be a lot bigger in the future. And I think there's like a need for a lot of these financial products around it. I think it's like not something that people will want to just only hold. I think they will want to do meaningful things with it. I think what those look like, the obvious example is like borrow lend, and there's like a bunch of companies that are tackling this. I think there are other things. There could be stuff like life insurance. There can be stuff like, trading, like, but in general, I think like Bitcoin, like as an asset is kind of like eclipsed, it's crossed the Rubicon. It's here to stay. Like, it's not going anywhere. So we should probably build, financial products and institutions, et cetera, sort of around this, I think.
Yeah. How do you feel? Okay. So like putting Bitcoin aside for a second now, how do you feel about like the L1 trade? Like where are we at with that? Right. We have had Bera launched recently. We have Monad coming out. There still seems to be at Story, the IP on chain. Thank God for that.
$61 trillion asset class.
Yeah. Every bit of IP will be on chain for reasons. What how do you feel like maybe like not such like a nebulous question, but like as a VC right now, how are you looking at this, right? Like the L1 trade? Cooked, not cooked? How are
Not
you
cooked.
feeling?
Not cooked at
Yeah.
all. I mean, like, it depends what you mean by trade, right? Like L1s, like the funny thing with, yeah, like, buying something liquid at a very high valuation is different than, potentially investing at like an earlier stage with like a lockup, et cetera. I mean, like the way the L1s have historically been valued is like comp down. Like, people think about ETH relative to Bitcoin, or at one point people thought about ETH relative to
Yeah.
Bitcoin. People think about Solana relative to ETH. It's like, it gets comped down. It's not, it's not fundamentals based, et cetera, right? And like the outcomes are just massive, right? Like, even a middling L1 still can do quite well. So that's like one side of it is like, the financial side, it clearly makes sense to potentially still invest in these things unless like they do significantly underperform, which is possible. Like SWE went to like 50 billion FDV this cycle. I don't think most people realize that or know that or thought about that, but that's like from like a venture standpoint where you want one investment to like at least be able to return the fund. That's like a huge portion, even if you're still locked, et cetera, on it for a long time. I would say the other side of it is that like all these L1s do have problems as well. And those problems represent like opportunities. So like one side of it is like maybe like if you're general purpose, like maybe there are certain properties that make it really hard to do certain types of activity. Like, I guess like the example or like the case study purpose built blockchain is Hyperliquid. And they like have all these like nice properties that, hopefully make it better to trade in a decentralized setting, right? Whether it's like prioritizing Oracle updates and having Oracles sort of with like the validator set, prioritizing cancels from market makers, a taker speed bump, stuff like that protects market makers. Not having to like having like a very like purpose built order book system and like purpose built consensus that allows you to like have really low block times and not have issues when a proposer fails to like propose a block, something like that. So I think there's like interesting stuff there. On the general purpose side, like the two issues that like a lot of these chains have today, one is like there's just an enormous amount of tech debt with most of these things, right? Like making changes over time to any of these systems becomes harder and harder and harder. And like, I mean, you kind of see this with like the pace at which like, I mean, Ethereum's like a little bit different. It's like much more mature, but like the pace at which like hard forks get through is like pretty infrequent, right?
Yeah.
Solana, it moves a lot faster, but like even the rate at which like new things get shipped in a meaningful way is probably slower than what a lot of people would want. I'm less familiar with like what's happening with Aptos and Sui, so I can't really comment on that. But I think like when you're able to move faster, you're usually able to better serve users. And all of these things have like limitations that exist today that like for them to push through and like manage this tech debt, organizational debt, et cetera, is like non-trivial, which often creates opportunity for other people. So like one thing I think is like none of these chains actually have like a meaningful amount of scale today. And I think a lot of people are like, Rajiv, why would you say that? Like, blocks aren't necessarily full. Like, maybe people don't actually want to use the chain that much. And that's possible. Like, maybe we're at the final form of that. But part of me thinks that like, having more compute for developers is a good thing. Having, lower block times, like more throughput, generally is good for users, right? Like it's some combination of both those things. And I think like we still have a lot of room to run. And I don't think any of these systems have been designed perfectly with that in mind. Now, that being said, you can build the perfect system and it doesn't mean that people will come and use it, right? So that's like a different problem, I think. But I think like the network effects for most of these chains are much weaker than most people expect.
Yeah, I think that's been like proven pretty much functionally true. Like even, I mean, a very simple example being like Ethereum and Solana. Okay, so the L1 trade's not dead. Do you have you either at your firm or in general with like just the funding market, have you seen like a meaningful shift towards applications though? Like this has been, a constant like point of discussion, like we have to build the application. The infra's there, we got to build the applications. You maybe have some skepticism as to whether or not the infra is really ready, which I think is very reasonable. But have you felt like a meaningful shift towards like application development and like, getting applications that people want to use in users' hands?
Yeah, I mean, I think people, I think there's a lot more interest. I would need to like look to see if like funding dollars have matched that level of interest. But I think if you talk to most VCs, they will agree with that. I think especially at like the seed or pre-seed stage, there's a lot of activity. I think like beyond that, you need to prove out some level of traction, right? That will justify, pricing or, where somebody thinks, something could be in the future. And often that is much harder than people think. But I do think I think in the last probably 4 or 5 months, there's probably been more application funding than there was in the year prior, if I had to guess. But also the other thing is a lot of these people who are building infrastructure now also understand that they need to build applications, and it needs to be good applications. It can't just be building hello world for the sake of running a test thing. It needs to be real. I think a lot of the ambition of many of these infrastructure builders now, which is encouraging, is that they would to have sustainable businesses that can support themselves and be able to earn their own revenue. And if your infrastructure cannot monetize well, that means you need to build some application that leverages your infrastructure. And there's a bunch of reasons to do that, both from improving a developer experience, business perspective, right? The other way that you fund yourself is you either just live off your runway forever, or you have to fund yourself through I guess a grant from a foundation, which results in token sales, stuff like that, if you go that route. But yeah, the other thing is I think a lot of these applications may not necessarily it's a TBD if they will have tokens or not, right? They might just at the end of the day, if you build a business, you can pick if you want a token, you can pick if you don't want a token. There's you control your own destiny once you're in a good spot.
How do you? I mean, this may seem like a bizarre question, but how do you generally differentiate between what is infrastructure and what is an application? If you had to give an elevator explanation of this, because the reason I ask this is Pump.fun, it was in my eyes and likely your eyes, initially it was certainly an application, right? It was an application. You went to the front end, they take a fee. Now they've launched PumpSwap, right? So there's kind of this interesting circular thing where we see application developers realizing they need to monetize their businesses, or infrastructure developers realizing they need to monetize their businesses. So they're building applications. Application developers realizing that they want to take perhaps a larger portion of the stack, and that could include potentially building infrastructure as a result. Where do you kind of view this? Where is the distinction in your mind? Because to me, it's very, very muddied, right? I never really could define
it's
the difference.
Maybe we can go through a couple of examples and maybe it makes it clearer. Eigenlayer to me is clearly, or restaking in general is clearly infrastructure, right? I don't think it's if you build a restaking platform, it's rare that the platform itself is the application, right? I guess maybe it's are you building a platform for other people to use? Are you does the platform happen to be part of something that's a first party thing that you own currently? I don't know. I think it's a little bit there's a little bit of muddiness there, I think. But maybe the platform-esque nature of something sort of is what that looks like. Uniswap, is it infrastructure? Is it an application?
Right, exactly. Right? It's all that's always been one where, and also even just given how their token works, how their DAO works, how their foundation works, how the labs work, all of these, it really muddies the water, right? And that's why oftentimes I find it difficult to even have a coherent conversation about this. Is okay, well, define application, define infrastructure, then we can sort of go from there. You know what I mean? Uniswap's a good example of that in my mind.
I guess to me, Uniswap is an application. I guess specifically because they maintain a front end, which generates a decent clip of their flow. I think it would be different if it's whereas a good example is okay, the closed source dexes on Solana, SolFi or ZeroFi or whatever, Oberg V2, whatever. To me, those are infrastructure to some extent, right? Because I guess maybe it being user facing, I don't know. I think it's honestly a little muddy, right? It's not revenue based. I don't think it's whether or not you're able to run a business. That shouldn't be the case for the distinction. So maybe it's being able to own the user experience or something like that.
Yeah, that seems right to me. And I would say this isn't the only defining characteristic, but one aspect of, well, I guess you kind of just refuted that by saying those closed source dexes, but to some extent, a closed source front end would be closer to an application in my mind, at least in a vacuum. Okay, on this note, what did you think of? Exactly, yeah. Well, what did you think of Pump.fun's decision to launch PumpSwap? What is your read on PumpSwap thus far?
It's clearly strategic, right? I think there's I don't know what decisions they made as a team to come to this. I can only speculate from the outside. But they own a front end that generates a meaningful amount of flow, specifically through I guess the long tail assets for the token launchpad, that product that they've created. And they have a captive user base, and it makes sense to try to verticalize a little bit once you have a niche that you can expand from, right? The fees on it, my understanding is the fees are like, meaningfully higher than they would be elsewhere. But like if you have a captive user base, like you can get a big premium for that. Like a great example of this is like Coinbase, right? Does Coinbase have the cheapest fees in the United States? No, absolutely not. But they have a brand which is trusted, and they have a captive enough user base that is willing to pay a premium or is ignorant to the premium that they're paying, which gives Coinbase the privilege to actually charge that. So it makes sense. I mean, also like they were clearly leaking value to Radium to some extent. I don't know if there was. I assume that and it just makes sense for them to sort of verticalize and kind of own the full user experience where possible.
Yeah. Okay. So now more just like a projection type question, like just like give me your prediction. Like, what do we see in a year? How much volume is Pump.Fund doing? Like, I guess what I'm asking is like, are we past the chasm of extreme meme coin mania, but maybe not just specifically that, more just like the actual like volume and revenues that they can capture? Like, have we peaked maybe with something like Pump.Fund?
I want to say no, but I think it's like, if you like look, there are a good number of users, but it's still like not that many users, right? Like it's not like crazy, like what you would expect from like a social application that goes like to top of the app store, kind of like user counts, right? Or retention, stuff like that. It's hard to say. Like I think it's very possible that like activity is like substantially higher a year from now, right? Like maybe people want to trade meme coins more. Maybe they don't. I think it's just not easy to say, because I think it's like very tied to like the assets that they have, which are currently like largely meme coins. And I think that's the main reason people go there. But if you cohort pump users by like amount they trade, the retention is pretty healthy for the people that like are actually trading a good bit. So and those are the power users. And for some reason, like also, who's to say? Maybe there'll be incentives. Like if there's incentives, anything can change, right? Like exactly. Most things look pretty. Like there's very few programs where incentives end and things look better afterwards. I think like the Hyperliquid airdrop was like one example of that. But who knows? Like I think it could be higher. I don't think we're at the end of meme coins though. I think that's probably overblown. I mean, you were never going to get like traditional institutional investors to invest in meme coins like that. That wasn't going to happen, right? But that doesn't mean that the retail like user base can't be huge, or like the capital base isn't large there necessarily.
Yeah, for sure. On the Hyperliquid note, then, well, what is your maybe give us just your general perspective on Hyperliquid, and then a more specific question would be, what do you think about the L1? Like now that this is launched, I don't know. I haven't followed so closely what apps are like sort of cropping up, but I'm curious, like Hyperliquid first of all, and then the decision to kind of like launch the L1. Obviously, we can talk about like how there's a massive premium ascribed to L1s, but just like in general, maybe talk about like your thoughts on how they've structured it and like what they're doing right now.
Yeah, so in general, they've built a very compelling product that people love to use, or at least like a cohort of people who specifically are perps traders love using. I think in general, the team is very competent. They move probably faster than if they're probably like one of the top one or two fastest moving teams in the space. And it's a very small team. It's like, maybe it's like definitely less than 15 people. I think it's like somewhere between 10 and 15 people, something like that, which is like very small relative to almost, any comparable project. And I think like it being small keeps the quality bar of people on the team high and allows them to move very quickly. Obviously, perp dexes are not a new thing in crypto. There have been a lot of different attempts at it. I think like the most prominent attempt before Hyperliquid was DYDX, and they had like the V3 rollup product, which actually was used a lot, largely because there was the incentives were quite large there. And I think the V4 product has not gotten nearly as much usage. I think so. From the L1 perspective, I think there's like a couple of things here. Like one is like, do you care about if the thing is like decentralized, like to some extent, right? And decentralized means a lot of different things here. Like, somebody who runs an L2 might say like, there's like a benevolent sequencer, and, as long as the user can exit their own funds or force included transaction, like maybe that's decentralized, right? Somebody else might be like, if you have the ability to propose blocks, like that's necessary for it to be decentralized. Or like no one party can control ordering, right? At any given, no one party can have a monopoly over ordering over like a long time period or something like that. So I think part of it is like just the ethos with that. Yeah, there's definitely a valuation premium, I think. I think part of it is like there's other niceties that you can get, like that you might want in a decentralized setting. Like the oracles are baked into the validator. Like the validators are the oracles, right? Like that's a nice thing to have. You don't have to rely on somebody else. So I think that's like pretty relevant. All of the sequencing stuff they do, I guess you could technically do as an L2. So like, prioritizing oracle updates, prioritizing maker cancels, like all of that's interesting. One thing I'm like not sure about still is like there's this taker speed bump, and I don't know if that's like built into the L1 or if it's like API layer or something. But in general, like it's just very impressive. They built a product that people love, and that's fairly rare. And it, at times the liquidity is quite good. It's like very comparable to even like, it might have less open interest and volume than some of the top centralized exchanges, but on major pairs, liquidity is often like close to par or like, not too far off from par. Relative to like liquidity on many of the majors for centralized exchanges, which is extremely impressive. And not all of that is HLP, I think, which is like something that often gets missed.
The Gwart Show is sponsored by Ellipsis Labs, who I've been following for 3 years now. They are one of the strongest teams I know in crypto. Ellipsis Labs is a small engineering team with a flat structure. They build complex systems, primarily in Rust. For engineers who like challenges, here's the kind of problem they solve. A layer 2 blockchain needs to maintain 100 million accounts and generate a state root after each transaction batch. The root must be built within 50 milliseconds. How would you design a system to ensure the root construction is fast enough? High-performance challenges are core to Ellipsis Labs' mission as they build modern crypto finance. They believe finance needs more than an upgrade. It needs a complete rewrite. The success of their first product, Phoenix V1, speaks for itself, doing over $70 billion in organic trading volume. Now, Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. I know this team personally, and I like them because they're unique in the crypto space. They have a long-term focus, they work in person from their New York City headquarters, and they're here to build products that fundamentally change the world of finance. If you want to learn more about their open rules, go to ellipsislabs.xyz/careers.
I want to ask you, like, coming at this as a VC, and maybe it's like a slightly different framing here. Like Hyperliquid airdrop, obviously probably the most successful airdrop. I say successful, like in terms of like happy participants, right? Like maybe in the past couple of years, like overwhelming support for how they did their airdrop. Obviously one of the big like selling points was that they didn't have VC investment, right? Like it was self-funded. Do you think that something like Hyperliquid, not from a technical level, but from like we were kind of discussing before, like ownership and like distribution, can something like Hyperliquid be built with VC funding and have a similar outcome in terms of like, appeasing the e-beggar community? Can the numbers work for a VC to launch something like Hyperliquid?
Yeah. I mean, so I think there's like a couple of levels to it. Like the first is like the ethos level, right? I guess when you take on an investment, that becomes part of your lore. When you choose not to take on investment, that also becomes part of your lore, right? Bitcoin famously had no investors. And I think there is like, Satoshi may have mined like a lot very early on, right? But like, I think the fact that it was, there was no allocation to external parties like early on, I think, was a big part of its lore in the early days and like a big selling point, along with like the ethos of like how the Bitcoin community sort of evolved. And I think Jeff probably has taken some inspiration from that. The second part is like, it was just a really, like there's like a couple of other parts here, I guess. One is the price went up a lot from the airdrop.
Yeah, exactly.
Holding on to like all the trading fees and using that to help like buy back or like provide liquidity for people to sell into without like moving the price downwards meaningfully, like is really useful. And I think that like having a good day one definitely helps, or like having the chart be, not painted necessarily, but like,
right.
Looking good definitely helps. I think the third layer to this was that it was a very large airdrop, right? It was like something like 37%, maybe. I could be getting the number wrong, but like around there. Like it was a huge airdrop. Like the typical airdrop range is like anywhere like, I feel like we saw stuff that was like sub 10% last year, which is like definitely on the low side, like upwards of like maybe 15%, on the high side. And that 37% is just like a enormous number relative to that. So like, I think like the important thing to think there is like, okay, like what are the considerations for how much a community can get airdropped? With VC investment, usually the way things are, structured, and like this is not always the case, but like oftentimes there's like 50% to insiders. So what does that mean? Like the team and investors would be insiders, right? So, let's pretend there's some world where, maybe Hyperliquid chooses to sell like, 5-10% or something. Maybe not, like, maybe the team still keeps their 23%. Some investor had 5% or something. It was like 30%, right? Like, could you still airdrop another 37.5%? Like, yeah, you could. It just means that the amount you have in your treasury is like less than, if you airdrop 10%, right? A lot of teams choose to hold tokens in the treasury, and there are like potentially like legal reasons to do that. There's potentially like, considerations around like runway, right? Like a lot of teams are unable to generate revenue. So the means by which they subsist is like through treasury management, which is like not a great business model. I mean, like, there's no reason people can't do bigger airdrops. It's just a choice, right? Around like how you want to allocate your treasury and float. I think like, I think the main difference is like if they took VC funding, even if they sold, let's pretend they sold 0.1%, 0.01%, like absolutely nothing relative to like the team allocation relative to the airdrop, et cetera. I think it just changes the ethos because it shows that somebody got access before somebody else. Whereas everybody had the opportunity to buy on the open market. Everybody had the opportunity to use the product and participate in getting the airdrop, which is a unique way for tokens to be distributed, which is, yeah. So I think it's really just an ethos thing that I think resonated with people, especially in light of like, I guess, the sentiment around, VC ownership and many of these other existing products or protocols.
Yeah. Do you think that, we have Echo recently launched, there's another one, Legion. Yeah. And then I guess if you want to take this to like the extreme, obviously you have Pump.fun in theory, right? I mean, there was a ton
of coins that were launched on Pump.fun, right?
Right. Yeah. Like I'm thinking more like the attempt at real projects, right? Like I guess this jelly thing, we'll see what happens there. But I guess my my overarching point is like there does seem to be some experimentation with getting tokens into the hands of people, community members directly, and sort of circumventing VCs altogether, or maybe that's not entirely true, right? Like a lot of the Echo rounds have VC investment as well, but like there are some experimentation here. Like, do you feel that VCs are, I don't want to say threatened, but like, have you taken into account now that perhaps there's like new models for funding, or there are certain projects that might go that route versus others? Like, how do you feel, I guess, maybe about just like the general idea that people are wanting to get, a sort of direct to consumer, direct to retail investment for these token rounds?
I guess like what's the so I think it's interesting generally, right? Like I think one thing crypto is super good at, or historically been really good at, is capital formation and like democratization of capital formation. So like to the extent that it's like legally, regulatorily possible, I'm like very open to it. I think when it comes to like these funding rounds, like it comes down to like what are the goals of like a project or a team, right? Like are they purely looking for capital at the highest valuation? Are they looking for like, a set of people who can provide XYZ services? Are they, looking to incentive or like distribute ownership early on that hopefully drives better retention and usage of like their actual products, right? And I think people have different goals depending on kind of where they're at. I think a lot of teams have indexed sort of on the last bucket, and I think it remains to like I think it remains to be seen if that will work well, right? Like I think just because you give the community the opportunity to buy at like a good discount, it doesn't necessarily mean that they're going to use your products more. I think there are actually some foot guns around like people understanding what vesting looks like, and also like not all VC, like I think a lot of people like dislike VCs because they're like, oh, this represents like a huge amount of like potential size, like sell pressure, right? Like that's ultimately like what people don't like, and the privilege access, like two of those things, right? And I think, the privilege access being more democratized makes sense. I think that's like a good thing. I think at the end of the day, like having more competition, whether it's like price, services, et cetera, like in conjunction with capital to founders is clearly a good thing. And like letting them optimize for what they want is a good thing as well. I would say that like there is definitely like, what's the right way of framing this? I think, okay, so like there's this other dynamic that's happening in the VC market, which is like, people are like, as as not all tokens are up only forever, there's like definitely a subset of things that tend to generate outlier returns, which has like been the case with like, traditional venture for a long time. As people have sort of figured this out, people have increased their ownership targets meaningfully, I think. And like, okay, like what are the ramifications of that, right? Does it mean that like of the percentage of the total supply, like, well, founders, like, if we're going to do the thing where it's like 50% allocated to insiders, if investors like, potentially are taking a lot more or pushing for a lot more and they're able to win deals because they believe they can provide, or founders believe they can provide services or are useful in some ways, like, does that mean teams will have less? Does that mean like the whole amount going to insiders will look different with time? Does it mean that like angels get squeezed? Like I've seen some stuff recently where it's like, yeah, the angels just end up getting less as a result because like the fund is like, I'm going to write a majority of this round and I need this ownership target. And then the founder doesn't want to be diluted a certain amount, right? Or they don't want to take on more dilution. So like the angels end up getting smaller checks. Like maybe it means the community gets smaller checks. Like, I don't know. It's well, it remains to be seen, I think. And I think some of this is probably dependent a little bit on like how market structure stuff goes. But in general, I'm pretty optimistic and like having more avenues for more people to participate in funding early on. I do think the market will get more efficient with time, where it's like if you're able to provide services or you have a brand premium or something like that, maybe you'll be able to get more size or get in a better valuation or something. And if you're not able to do that, maybe the way you participate is like you just pay a higher premium. But I think the other way is like, yeah, if democratizing it to your community early on ultimately drives better engagement and retention, which like it's going to take some time to play out, then like, yeah, definitely more founders will go that route. But
yeah, it's also like, I mean, to defend, let's say defense. I mean, I don't know if this is so much of a defense of VCs or more just like a practical statement, but like the reality is that VCs are, I don't necessarily have, I don't always know that like the vesting is very fair, but VCs do take on this like early like lockup for an extended period of time. And we see that retail is, I mean, you have people launching on, this is an extreme example, obviously, but you have people launching a token on Pump.Fun and just absolutely nuking the chart for like $3,000. It's very clear that like these are different, these people have different time horizons. Like, of course, that was a poor example. So I think it's reasonable, I think it'll be interesting to see with a lot of, for example, like a lot of these, Echo rounds or Legion or just even these kind of like more, direct to retail, like token sales. Like it'll be interesting to see like how quickly these people are just like max nuking, their entire stacks. Like, so
it's also like, it's a sizing thing too, right? Like, some of these Echo rounds, like there's, or like not Echo specifically, but like for some of these rounds, like that involve the community early on, there's like max sizes you can put in. For some folks, that's like, a really large amount of money to them. For some folks, it's a very small amount of money to them. And their like often what I found is propensity or willingness to help, especially for folks who might be, uber wealthy or something, like they just need higher ownership essentially to be able to put in the requisite amount of time. Which like, it makes sense, right? Like you probably like, if you're going to put in all this work, you want to make sure it means something. There's a lot of people like, especially angels that will have less ownership and still be willing to do a lot of stuff there. But, like an interesting thing, like an interesting idea I've had is like, okay, what's the max amount you could raise? Like if somebody raised $100 million, could you do that purely from the community, right? Like, okay, like let's say that's a crypto thing. Let's say OpenAI, like, they wanted to raise $40 billion more. Like, like how much, like, I assume that there's a lot of retail, like, if they could participate, like they could, but like, like that might be like the buzziest company or whatever, blah, blah, blah. Like how much money can you actually get into the thing, I think is the other part of it. And my guess is it's like, I actually am not entirely sure where it would land. I think like there's weird dynamics where it's like, if you price stuff in BTC, you probably raise more than if you price it in dollars, right? Because people who own a lot of BTC, they don't think that much about like one BTC maybe, or like, a lot of BTC, or even like somebody who doesn't own that much who has 0.001 BTC. That feels a lot better than, whatever the corresponding dollar amount is, right? So there's like weird dynamics there that I think are that people can still play with. Like one thesis I have generally is that like, I think we're going to get like, I think there is actually like, and I'm probably like, people are going to say I'm so stupid for this, but I truly believe there's like a real opportunity to build like more ICO like stuff. Not in the sense that like, oh, we need like, Dentacoin or something like that. But like, I think like if there's a real pathway from raising capital from people and you're able to bring in like assets that people, mentally value differently, like you can probably bootstrap stuff a lot faster. And like, there's a whole bunch of hurdles there. And like, maybe some of it is reg arb, but like, we're clearly very good at capital formation. It's just a matter of like, can you get into the hands of the right people? And are people comfortable with that? And can you not go to jail in the process, right? Like those are the three things.
Well, in the context of like, I don't know, maybe more quality assets, like I have no qualm saying this, like as somebody who's generally like pretty cynical and critical of tokens and like constantly shitposting, right? Like I think it's very reasonable to say, I mean, you heard the guy from Robinhood, right? Like Vlad, whatever, recently talk about this. Like if you could get access to SpaceX or OpenAI, right? These like large private companies that have, for whatever, various reasons, not gone public, but if you could provide retail access, now those are like much more on like the quality asset side, if you will. To me, that's like very intuitive that we could like tokenize the stuff. I guess my sort of just slight point of contention is like, that's fine. That's, to me, it's like changing the form factor of an asset doesn't necessarily, sure, you can tokenize this. It doesn't like necessarily change like the legal and sort of like regulatory balance of it.
Not, right?
Exactly. And so that's where I
that's the whole other side of it.
It's like, okay, sweet, we can bring like Tesla and Amazon on chain, but like it's still just like the securities, right? And like it definitely is moving in a direction that is not like exactly what we've thought of crypto thus far, which is fine, but we do need to distinguish that, right?
So like let's run out the thought experiment. You bring like high quality assets on chain, like who benefits, right? Also, what does it mean if you have like an asset on chain that's like, potentially much larger than like, what if you had like all Tesla stock on chain, like on Solana, right? Like, what, you have a meaningful amount of supply that like what happens to like sold the asset, right? Or like what happens to like, the security of the network, et cetera. But I think like the natural beneficiary, like if you get higher quality assets on chain, assuming that there is a meaningful, like assuming they can be like transferred and transacted with, et cetera, is like probably DeFi stuff. Like I think, like there's, in my mind, there like some of the DeFi, like the DeFi stuff is not perfect, right? Like there's still like, clearly everybody comes up with a new mechanism to like improve market structure, in some way. But like for a lot of things, it works okay or well enough, right? And it would be nice to have like be able to do more with some of the assets that you have, right? Like how many people earn like any yield like on like the stocks they hold in their brokerage account? Like most people don't even know that like, you can do like, secured lending out for stuff like this, right? Like there's like stuff there where it's like, you're a long-term holder of Tesla. Do you want to earn like, I don't know, like what I would have to look, but like, what do you want to earn 2, 3, 4, 5% a year? Like on that, like if you're going to hold this thing anyway, like the answer is probably yes. Right. So like, this could all happen in TradFi too. I don't think it's like, oh, it's clear unlock. And yes, there's probably some reg arb where it's like, yes, easier for ex-US people if like they find a way to like not be KYC to like access this stuff, to access it. But that being said, I think like just increasing velocity generally probably is beneficial for DeFi. Like I think DeFi largely suffers from lack of quality assets,
right?
Sustained demand for quality assets. And to be fair, I'm not convinced necessarily it's going to be like spot stocks. Like my hunch is like the people who are on chain today, a lot of them have access to equities markets in some way, shape, or form, and maybe they're going to want to cross margin that stuff with like their crypto assets. Maybe they aren't. My hunch is like the thing that would probably be more interesting, which is like, huge reg arb and like probably will get you in a lot of trouble, is like, giving somebody like a huge amount of leverage on some single name equity or something like that, right? Like, letting somebody go like 75x Nvidia, like I'm sure there's a lot of people who would use that, right? Like how much leverage can you get? Like,
and just the ease of like using perps is like so much more like seamless. I think that is generally the direction that I again, like the regulatory stuff's so up in the air, but like I do understand at least like at a basic level why someone might want, this kind of like Jerry from Ellipsis. Like I think he has sort of a good framework, which is like we're looking at using crypto as kind of like this universal API, and like even being able to, just have your Tesla shares on Hyperliquid, and if you want to go 75x long, right? Like that is an unlock in some capacity. Just like it's cutting, it's much more seamless, right? And like you can control the self custody aspect. Like now we're starting to get into like what does that mean, and that doesn't. It's not so relevant,
there's
right?
Ways around that too. Like clearly, like people are willing to like use these like different setups, right? Where like somebody might actually like hold two of the shards, but you can export your private key, whatever, right? Like,
Right.
It's like somebody else sort of custodying, doing the signing for you. And like, that seems to have like crossed the Rubicon in the last couple of years as well. So, it's interesting. I think like there's a lot of demand. And then the last part is like, so like thinking about building for existing crypto users is probably pretty different from building in for like net new potential users, right? And like, do they need to know they're touching a blockchain? Do they care? Like, what's actually important there? And like, for the most part, like, I think we haven't really figured that out. The main times that we've brought in new users have been via like net new asset creation. And I think like the only way for like really any chain to go to market, I think, is like enable some net new set of assets or UX that's just like amazing, or some combination of the two, right? And like no chain's ever had sustained usage without one or both of those, pretty much. So that's also like the other part of like going back to the L1 thing is like, or L2, whatever chain you're building, L3, L4, I don't care. It's like, which, you probably shouldn't do that anyway, but that's a whole separate discussion. Is like, you need to have a reason for people to be there, and it needs to be meaningfully better than the alternatives. And like a really clear example of this is like, how many of like your crypto friends do you pay with stable coins? Like the answer is probably very, like if you're a US person, like almost always, they're always just like, okay, Venmo me or something. Like none of the US people are like using stables for that, right?
I have a hilarious story about that.
Right? That's like different, if you go to like another country or something like that, where, people actually are holding on to stables and using them in meaningful ways, et cetera. So I think like building for US base is like different than building for the rest of the world. Like building for crypto natives is different than building for net new users. It'll all merge eventually, and you got to find some wedge to kind of get into the market and like beachhead it pretty much, and then expand from there.
Yeah. Kind of going to that like L1 point and just like generally like quality assets topic. This is like somewhat adjacently related. There's
to be
been
clear,
some...
you don't need quality assets to start with. Like every time you've had an explosion of users, most of those assets have like fully died, but they were new, interesting assets, most of which like you could only access by using this chain, if that makes sense, right?
Especially like incentive programs like the
and that's fine. You just need a beachhead to like get people in and capital in, and ideally over time you're able to transition into higher quality stuff that has meaningful retention. The problem with low quality assets is the retention looks pretty bad. Yeah.
And we've mainly had like low quality assets like on a long enough time frame. But okay, so I want to ask you then, like, you can probably guess my own personal opinions about this, so I won't like necessarily interject. But there's been a discussion as of late, like with regards to, I mean, I've seen this with regards to Ethereum, but obviously the same logic could apply to, any L1 for that matter. But like seeing this logic, which is that, okay, we're having this, boom in stable coins, and like stable coins are the big unlock right now. It's not like so maybe interesting to, like you said, us US users, like it's not like a fascinating unlock, but for all intents and purposes, like this is clearly like something we can, genuinely point to and say like, okay, product market fit, right? I'm curious your thoughts on, for example, I've been hearing this, the best way to invest in stable coins is buy ETH, right? Like the L1 asset of where most of them will be traded. And I think it's ETH has like by far the largest, is that more than Tron? I'm not sure, but regardless, they have a ton of stable coins, right? So what are your thoughts on that? Like the way for retail to invest in stable coins is by buying, kind of the underlying chain asset.
I mean, look, that is one way to express an opinion, I think. The market will show you if your opinion is good or bad over reasonable time frames. That's probably not the way that I would choose to express it. But I think that being said, it's also partially because like ETH is not, purpose built for that stuff, right? And you have to think about like what people use stablecoins for on ETH as well, right? Like, are they using it just to hold it? Are they using it for financial activities? Like, is there like any velocity with like the stables, or is it mostly like, low frequency, like borrow lend, like, or stuff like that? So, I mean, like, look, maybe it's the right way to do it. It's probably not the way I would do it, but I also think that like, there are worse reasons to invest in something than that.
Thanks for listening to The Gwart Show on the Blockspace Podcast Network. Subscribe to our newsletter at blockspace.media to get the show directly to your inbox. Show links, transcripts, and Bitcoin articles twice per week. Stay ahead of the conversation by visiting blockspace.media.
What VCs, you don't necessarily have to name them specifically, but what VCs will do well this cycle, and what VCs will get wrecked. And like I said, I'm not asking you to name names, but more the types of investments that either were made in the past, call it 3 years, or are being made now. Like, who's going to have success and who's not. And if you want to name names, I mean, feel free. Like I have, I can offend anybody, but for, personal reasons, I understand why you wouldn't want to, but I'm curious, like who do you see doing well and who do you see kind of flopping maybe?
Okay. So like, are we talking, I guess the other distinction that's important to make with VCs is like, some VCs like have venture vehicles. Some people have liquid hedge funds. Sometimes the venture funds will not do well. Sometimes the liquid hedge funds will do super well, right? And like that VC or, investment firm does super well in the process, even if like, potentially, one fund does well and one fund does not, right? So, and those are like different skill sets to some extent, I think. So I think that's like an important
Can I, let me just ask something, like just for some insight, like, because I'm not so familiar with this, like what would be a reason that, for example, like the VC arm doesn't do well and then the liquid fund like does quite well? Like what would be the dynamic that sets that up, out of curiosity?
I mean, like depending, like some of it can be mandates, right? Like maybe you're able to invest, like, so like maybe, and this is like, I don't know, I won't speak on behalf of other people. This is all generalizations. But like maybe like in your mandate, you're able to invest in like, more liquid assets or have shorter time frames in the liquid vehicle. Like, maybe you're able to like buy like convexity on assets in your liquid vehicle that you're not able to like in a venture vehicle, right? And then measuring performance like also comes in a few different ways, right? Like is it amount like is it like where your book value is? Is it like the amount of capital you've distributed back? Like is it the IRR on the capital that you distributed back, right? Those things all look a little bit different. Depends how the funds are marked too. Like some liquid funds get benchmarked to USD, liquid funds get benchmarked to BTC. Obviously, one of those is probably much easier to beat than the other, right? So, there's stuff like that I think is like unique. But yeah, it comes down to like the agreement that LPs have with the investment firm and vehicles that they are responsible for, I think. But without all of that being said, I think like on the venture side specifically, I think the things that will be harder. I mean, like, look, I think there are not that. Historically, or at least as of the last couple of years, there have not been that many outcomes that have driven, meaningful returns, whether it's on paper or like, dollars actually returned for people. So my hunch is like the bigger your fund is, the harder it will get. Unless you're able to leverage that size to price other people out or get to things like, or get, huge ownership sort of and stuff consistently. And hit kind of like the right things. So I think that's one thing. I think like larger funds, it's probably a little bit just tougher. Like, I don't know, like what are you going to deploy into? The flip side is like maybe these companies, like historically crypto companies have not had to spend that much capital. Most of them there's probably some distinction here for like the ones that are maybe a little bit more enterprise salesy, where it's like, there's a workflow. You can like, hire XYZ number of people, you can generate XYZ amount of revenue by reaching like certain customers that way.
Yeah.
A lot of teams, consumer or, protocols, et cetera, like the main cost is just like headcount, right? And like hiring good people is like not trivial necessarily. And like maybe some of this changes with like the AI stuff, like, which is a whole separate topic, and like having more dollars is probably a good thing there. But like it's not clear how you spend that much money as a company, right? Unless you're just spending it like on egregious stuff. So my hunch is like larger and larger funds, like some of the mega funds might have challenges, but like they also have they have a tougher mandate, right? Because they're a bigger fund and they know that, and they might do great, honestly. Who knows?
Yeah.
So I would say like people doing that. Also, like, clearly the market does not value things without traction. Like any level of traction, right? Like I think people are realizing that, if you build something just because it's marked at a certain price, you unlock vest over that time frame. Even if you're selling like as early as you can when you vest, and we're not even talking about like doing stuff where you break agreements, where you like sell forwards, which you should not do, et cetera, blah, 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 like very bad behavior. More people need to call this stuff out. Nobody should be happy with this. It's like not good. Unless there are willing buyers, the price comes down if there are more sellers than buyers, right? So how much are you actually getting out? Like what was the actual return on it, et cetera? And like really the only things that feel like they're going to have, or in my opinion, and I could be wrong here, the only things that feel like they're going to be able to have, sustained usage or potentially do better than they did in previous cycles, or just than they are today, is like, things with meaningful traction. Now, there's a whole other segment, which is like, are these things that are already liquid, are they going to outperform BTC? And like, there's very few assets that do that. And I think it's possible, but again, like, it depends like where you mark things from. Like, are you marking it to the all-time high? Like, or did it make a new all-time high relative to BTC? Are you marking it from like where the asset originally launched? Like, there's a bunch of stuff there that looks like, depending on how you slice it, looks very different. But
I think like putting like BTC aside for a second, because it's not lost upon me that VCs over 4 years can outperform Bitcoin. In fact, like and especially like if you go back to
more than 4 years. Remember that, right? Because you invest, and then the thing has to build the thing. And even if like, let's say everything launches a token, which is not the case with most of these funds. Like, generally standard 4-year vesting. Like, are you selling all of it right away? Are you going to sell all of it by the end of 4 years? Like, maybe you're like a proper venture fund has a 10-year time frame, right? And like, maybe most of these coins shouldn't be held for 10 years, but like, I think a lot of people, to give benefit of the doubt, I think most of the good funds, I think, are actually much more long-term oriented than retail would like to believe.
And that was kind of like the point I was making before. Like, these funds are taking on like very long duration relative to what like the retail participant is accustomed to. I think that the point that like I got into it, of course, with like Chris C recently, and I'll have him on. Like,
this is gonna be a good pod.
It'd be interesting because like Twitter is obviously not like such a great like format for like expressing my ideas, and oftentimes I'll concede that I go out of my way sometimes for like engagement bait. But I think the problem with the way that I see it is like, my read on the vast majority of tokens in the past, like, call it 4 years, is that once they are liquid, like once they're trading liquid, it's like most of those like greatly underperform even like US dollars. Like, but the counterpoint to this, and why it makes it somewhat of a difficult discussion, and if we do end up debating, like, we're going to have to set parameters, because it's not lost upon me. For example, like, here's a very, very like simple example. Like, let's say a VC invests at 50 million, okay, and the project launches at 5 billion. Okay, over the course of 5 years, that slowly sort of bleeds to 500 million. Okay, my point, and whether or not this is a good point or an intuitive point or a point that's not worth being discussed, is that once these hit the market in terms of like the public retail, they largely have been poor investments. But it's not lost upon me that scenario that I just described, the VC 10x, right? Yeah. And so like this is the kind of dislocation in the market that I probably have more of a problem with. Like, both can be true in the sense that like VCs can make 10x's, and retail could also have shorted every single public launch of a token and had a positive outcome. Granted, I don't know how feasible it is to short a token. You know what I mean? Like, short a token over a 5-year time frame. It's like not a typical investment that people make. But like, I'm giving an example, right, where like both of these scenarios can be true, and like that is like, I don't know what the second order kind of like what you would read from this. Is it like this kind of high like FTV low float dynamic? Like, what is kind of playing in here? But it is a real problem, right?
Yeah. So like, for what it's worth, this happens in public markets too, and that's not a justification. Like, I think in this, like, maybe things probably should have gone, like, there are people on Twitter who are much more informed than I am, like, some of whom will say, like, staying private is great forever, like, just let the valuation like slowly tick up, like, don't have like a price you have to look at every day. There's other people who are also like, it's clearly much better for everyone and for markets to like go public very early and allow for people to participate in the upside, et cetera, even if there's like more volatility. I think the interesting point about like you invest at 50 million, you go to 5 billion, and then, let's say, everything is out at like 500 million or something like that. So it's a 10x. But how much money did you invest at $50 million? Like, let's say you bought, 10% of the supply, which like, should somebody own 10% of the token supply, right? Like, I don't know, like, should they own 20%? Like, I'm not, I think that's personally quite high. I think some people in the space would be like 10%, like, makes a lot of sense for people to own. There definitely are funds that go after that. I guess it depends if it like cares about being decentralized, et cetera. But let's say you own like 10% at $50 million. You put in $5 million and you got out, you didn't get diluted at all. You like got back $50 million. Now, like, think about like, what is the fund size, right? Like, the other interesting part about this is like, what are fund sizes, right? So like, let's say, you're like a 300, 400 $500, $300 million, $200 million. Let's start with $200 million. Like you get 50 million out on a $200 million fund. That's a quarter of the fund, right? Like if you're a $500 million fund, that's 1/10 the fund. If you're like a $1 billion fund, like $50 million, 5% of your fund, like, you know, if you hit 10x on everything, that's great. But like, you know, obviously there are actually a lot of zeros. So like, getting out at 500 million is really not good for VCs, right? Which means that like you need something that can get like to like, you know, much like, at least for the bigger VCs like ourselves, like you need something to get much higher and actually like stay there, which means that there needs to be like traction, revenue, like there needs to be some reason for it to be there, whether it's like through fundamentals, whether it's through narrative, like over a sustained time period, because otherwise like you're not actually returning much for your fund at all. Like it's just like, imagine you had to hit 10 home runs every, like 10 X's, like that's like not trivial to even 1x your fund. Like that's like not easy by any means.
Yeah, I would say, okay, so like I've speculated on this and I don't have any really good reason to think this apart from just like intuition, but I think we are slowly headed in the right direction generally with like these, you know, high FTV, low float, like generally, you know, being priced more correctly by the market. We saw this like, for example, with Scroll, where their last round was higher than their launch and it's subsequently gone down. Like that right there is it should be like, I mean, not to like chastise Scroll, but like that should be encouraging. That should be encouraging in the sense that like a lot of what, you know, retail participants like on the other side of these have often assumed to be this kind of like privileged access. Okay, like we're now seeing the market working this out to some extent, right? One thing that I've surmised though is like I think back on like the 2019 through 2023 era, and you talk about like a lot of these things were zeros, and I wonder. I think those funds, and you have much better insight than I do, and I don't know how long Framework's been around, but like I don't know that there were that many like pure play zeros within those funds. Like just because of the guaranteed liquidity, because there was like because you do have this like like for a lot of projects, right? You have a token that's always going to launch, and like I think back on those, I'm like, man, those like. I don't know how many of those investments, like in aggregate, were written straight to zero, right? And I think you're right now more likely that's going to be the case. But back then, I just look back like, man, that was the golden age, right?
Yeah, I mean, like, look, I think like there's like some metrics that are out there probably around like, you know, fund managers love to use this word vintage, which I kind of hate.
Yeah,
but, like,
I know it's confusing.
I'm just like, why does it need to be a vintage? Whatever. But like, you know, stuff from like 2019, 2020, I think is like probably pretty good. My guess is like the stuff from 2021, 2022, like NFT mania, probably not as good. And then like, you know, 2023 onward, I think has probably been decent. At least on paper, right? Like the other thing is like, you know, have people sold things? Have they returned capital, right? You know, that's the other part of all this. Like there's paper marks and there's like the real money that you actually get out and that you actually return to LPs. And again, like, I think people will be surprised at like how long-term oriented many of like the quote unquote credible funds are, and like holding things that they, you know, holding things like, you know, I guess a lot of people have made a lot of money from holding things that much longer than they ever should have, like Bitcoin being a great example, right? Like there's probably a bunch of reasons, different points in time made sense for many people to sell, right? I think people have also brought that mentality to a lot of other assets. So there are definitely examples of funds who have like sold the top on XYZ assets and done super well in the process. And you hear about the ones that like get to like, you know, 5 billion, 10 billion, 20, 30, 40, 50, 60, 70, 80, 100. And those are huge outcomes, right? But like you sell the top on like a $250 million asset. If you have a big fund, like it doesn't matter. And like, yes, you won't, maybe not get zero, maybe you'll get your costs back. Right. But again, like, you get like the other thing with VC is you get benchmarked relative to your peers. So like, if you underperform them, like that's not good. Like why would people want to give you money if you're not making as much as, you know, somebody else and they feel like they can trust you, et cetera. So, I think people really underestimate some of those dynamics. And again, a lot of it is like not public. So there's no reason for anybody to have assumptions. There are definitely instances of people like, doing really well. But I think in general, like, you know, Michael from our team talks about this a lot, but like a big theme is like just dispersion. Like I think like the winners, there will be way fewer winners. Those winners hopefully will be big, maybe not, who knows how big they're going to be, but there will be fewer winners and there will be a lot more losers. And it's really important as an investor to be in the winners, right? And to hit the winners, I think.
No. And that's why also I said like, most of it is like speculation on my part, right? Like I often don't times
There
don't know
definitely
the
are
exact
cases though. Like I don't think it's all
yeah.
like I think you're right about this. Like I think it's not as easy as people would think, I think, which sounds really stupid and conceited, but it comes down to like the parameters within your work, what you're working in, right?
Yeah. Okay, I'm going to ask you one last question. It's like kind of unrelated to a lot of what we've discussed thus far, but like, a lot of the discourse on Twitter for, I don't know, the past 6 months, years, largely been like this financial nihilism. It has been just like, it's very uninteresting at this point because it's like very clear, like we're all in that state, but like, need we talk about it more, But then I think there's like a strong sort of pushback against this. And yeah, maybe a lot of this does stem, or at least a portion of this stems, right, like from what retail is perceived as like the dynamic between VCs and retail. Like this has just been like discussed like ad infinitum at this point. But I'm curious, like, I want to give you an opportunity. It's like a pitch. It's not a pitch of an investment, but it's just like a pitch of an ideology, perhaps. Like I'm sitting here and I'm like observing and also probably partaking in a lot of this financial nihilism. But like, I'm willing to believe in something, right? And like, I know that sounds ridiculous, but like I'm not so cynical as to think that like this is just all a massive cesspool. It needs to burn to the ground. But I guess what I'm curious about is like, okay, so now we have this pushback against financial nihilism, right? Like, what should encourage us to like, what like are some, I don't know, I was going to say tangibles, but they don't have to be tangible. But like, I'm curious, like, what have you seen in the past 6 months, or like, what encourages you to like want like market participants to believe in something, like why should we change our mind? Maybe like, and you're coming at this like from, you see a lot of deals, one. So like, I think you have a good perspective on that sense, right? Like you see a lot of deals come across your desk. Like you're looking at what people are launching, like what inspires you, and like then should, in theory, subsequently inspire us.
I think it comes down to like, there are some really, really, really good people that are starting to work in the space. Like I think anecdotally, like of maybe like the 10 most talented people I know in crypto, like probably 4 of them in the last like year have started companies or chosen to start companies. And I think the interesting part about this is like, the reason these people want to work in crypto is they deeply believe in like the mission of democratizing like largely like financial access to things, right? And I think like DeFi was like a huge reason a lot of people came into the space to begin with. These people all want to build real businesses. They don't just want to launch a shitcoin and like let it vest over 4 years. And they're extremely serious about building a real business, even if it's like the long and hard road.
Yeah.
And then I think the other part of this is like, if you are talented, driven and ambitious in crypto, there is like no dearth of resources for you. And that's not true anywhere else pretty much. So like if you want to go out and like actually change the world, it is very reasonable. Like people are very open and willing to support that in a way that would be very hard to find almost anywhere else. Yeah. And we don't need everything to work. There will definitely be some bad things along the way, but I think arming the right people with all of like the ammunition possible essentially to go out and like actually tackle stuff like that, I think is like one of the best things that we can do. And I think people are gravitating towards. The other side of it is like, I think people are catching on to like, there's like now a discourse where it's like, there's a lot of things that clearly like potentially could make money, but may do crime or like be kind of like scammy or like not the right way to support the space in the process. And people are actively choosing not to invest in that, knowing that there is potential money to be made. And I think like we are pulling away resources from those people and arming other people. And that's not everyone, to be clear. There's still going to be cracks that get slipped through, et cetera. But like my hunch is like over a 5-year time frame. And like, yes, 5 years is so hard for anybody to think about. Like, what was I doing 5 years ago? It was like COVID, right? Like a lot has changed. 5 years from now, a lot will probably change. 5 years in crypto time, like, most people can't even think like can't like hold a, per position open for like more than 5 minutes, right? Like 5 years is like too long to think about. But on a 5-year time frame, I feel optimistic and somewhat confident that we will wash away like a good portion of the grift that I think has contributed to a large degree, like the nihilism that like I think people have experienced. Yeah. And I think people are getting better about calling it out as well. People are better at not funding it. I'm optimistic that regulation will help, help clear some of this as well. But I think like we just have to wash away a lot of the grift. I think that's really it. It might not be as explosive. It's like not as fun when it's like, it takes time. Like what crypto people love is dopamine hits, and like they love new metas because you can be early to it. You can like make a lot of money on it. You get huge dopamine hits. There's like something to believe in. And like all of those things usually like have some kernel of truth, but like building out the real thing and getting sustained adoption always takes time, almost always takes time. And the best thing that we can do is just continue arming the right people to kind of go after it. So I don't know if that's expiring, but I think it's like we have the right people and they're getting the right set of resources. And I think that's like almost good enough. And if you're good and you don't work in crypto, like if you want to do almost anything, like it's going to be much easier for you to do it in crypto. Not telling you to launch a token or like whatever. I'm just saying like it's easier to amass resources to go do the thing than almost anywhere else. So yeah.
All right. Well, that was inspiring. I felt like that was inspiring. Founders out there, if you want to get in contact with Rajiv to pitch him your real business, where can we find you?
Twitter, Rajiv POC.
Awesome. All right. Well, thanks so much for coming on. It was a great discussion.
Thanks for having me.